Hey, it's Tom here and welcome back to the channel. So the A2 Milk Company, a market darling here on the NZX in New Zealand for a very long time, and one that was a market darling up until very recently really in the grand scheme of things, is down big again these last couple of days. So as I'm filming this video, it was down about 10% or so yesterday. It's down an additional 6% or so today. And that is basically on the news that the A2 Milk Company has come out again and downgraded their earnings guidance for this financial year. Now, I'm starting to lose count of how many times the A2 Milk Company has done this. I believe this is the fourth earnings downgrade for this financial year. So things kind of going from bad to worse for the A2 Milk Company. And I basically want to give my perspective on the latest news in this video, and also talk through how I'm basically analyzing this news from the A2 Milk Company and the A2 Milk Company business in general in terms of potentially making an investment into the company. Now, of course, anytime we're talking about an individual stock on the channel, this is for entertainment purposes only. Please don't take anything I say in this video as a recommendation to buy or sell shares in the A2 Milk Company. And also, as much as I do feel like I'm kind of watching this one from the sidelines, in the interest of full disclosure, I do actually have a very small shareholding in the A2 Milk business. Like I say, it kind of feels like I'm watching from the sidelines because I'm used to having 10 or 20% kind of portfolio allocations to individual stocks. And the A2 Milk Company is absolutely nowhere near that for me. But with all that said, it's starting to get pretty interesting for me with these reduced prices. So let's talk through all of that in this video. If you haven't already, please hit like and also subscribe to the channel. And for now, let's get into it. Okay, so this is some of the highlights from a press release put out by the A2 Milk Company on the 10th of May 2021. Now, I will leave a link down in the description below to the full market announcement if you're interested in that. In conjunction with this market announcement, there was also actually about a 1 hour long conference call with management. So management went through and basically explained what they explained in this document, but they also took a whole bunch of questions from analysts, which I personally found very useful. It's kind of nice to have analysts that know the business well kind of asking key questions about the A2 Milk Company that you potentially might not have thought of. So all that will be linked down in the description below, but for now let's get into the summary of this trading announcement. The key points are as follows. The trading dynamics in the China infant nutrition market have been and continue to be challenging for A2 Milk Company and many international competitors. While A2 Milk Company's third quarter 2021 trading was broadly in line with plan, it is clear that the actions taken to address challenges in the Daigou/reseller and CBEC channels will not result in sufficient improvement on third quarter 21 in pricing, sales and inventory levels to meet our previous guidance based on April sales being well below plan. The board tasked management to undertake a comprehensive review of inventory in the trade, and this work has indicated that the level of channel inventory is higher than had been anticipated. As a result of the inventory review, it's clear that the challenges in the Daigou/reseller and CBEC channels have been exacerbated by excess inventory and difficulties with visibility. In the interest of the long-term health of the A2 Milk brand and the medium-term trading outlook for the business, more aggressive actions to address excess inventory will be taken, which will impact FY21 revenue and EBITDA and potentially first quarter 22. The inventory management actions being taken will provide Chinese mothers with the freshest infant formula and benefit the company's customers, distributors and partners. The company will also increase marketing investment in fourth quarter 21 and into FY22 to drive consumer demand. Despite these short-term setbacks, the company remains confident in the long-term opportunity that the infant nutrition market in China represents and is determined to build on the strong position which the company has built within this market over the past 5 years. However, the company recognizes that the China market and the channel structure is changing rapidly and therefore commenced a comprehensive process to review its growth strategy and executional plans to respond to this new environment. In addition, the board is actively considering capital management initiatives, including a potential share buyback, and an update will be provided at the full year results in August. Okay, so a lot to take in and kind of digest from that particular update from the A2 Milk Company. As I see it, there's kind of three main parts of this update that you need to be aware of. So the first part is basically excess inventory. The second part is the Daigou or reseller channel. And the third part, which I'll talk on briefly, is around share buybacks. Now, in terms of excess inventory, basically what this means is the A2 Milk Company has produced all this formula from the partner Synlait, which is where the A2 Milk Company gets their actual milk supply. They've basically manufactured all of these tins of A2 Milk infant formula, and they just haven't been able to sell it fast enough. And that's meant that over time, they've had this buildup of inventory that's kind of just sitting in warehouses or sitting on shelves or sitting with some of their Daigou resellers that they just haven't been able to shift, haven't been able to move. And this comes with a couple of problems. Now, clearly there is a lot of money tied up in inventory. So the more that you have this big inventory buildup, the more kind of working capital and cash of the business is kind of just sucked up with that excess inventory that, could be used for other things. Now, that's one part of it. The other part of it is with the actual specific products of the A2 Milk business, largely being infant formula. The more that you have inventory sitting there and the older that inventory starts to get, obviously at a certain point the end product starts to deteriorate. And if you get into more detail on this press release, you'll see that A2 Milk's management has made a couple of changes when it comes to managing some of this aging inventory. So one of the things they're doing is they're basically taking the freshest products they've got and they're basically swapping that with some of their older inventory that, some of their customers are then going to on-sell to the end user, being, mothers feeding their children infant formula. They're basically switching out that inventory. So they're replacing some of the older infant formula that's sitting in warehouses and on shelves and so on with newer infant formula. And quite a substantial portion of that older inventory is actually going to have to be destroyed, and that is why you see some quite big write-downs on that inventory from the business in this press release. Now, clearly, anytime you're having to destroy your product and not able to get it into the hands of consumers, that is clearly a bad thing. And I think this has kind of a couple of flow-on effects for the business. Firstly, I think it's good actually that they've recognized that there is a problem and they're going to have to discard some of that older inventory. One of the really important things for the long-term future of the A2 Milk business is to maintain this sort of super premium brand wherever possible. So the last thing you really want is end consumers getting old infant formula that's just no good, because that of course means that people aren't going to come back and buy it again as much as they would have otherwise. So that's the first thing. The second thing is they've frankly just had far too high expectations for their sales. I think when a lot of the world was going into lockdowns, the A2 Milk business actually had stellar sales numbers, really good sales numbers, and it was basically because a lot of people were just stocking up. We saw people rushing into supermarkets and so on for all sorts of products, and A2 Milk's infant formula was no exception to that. So they experienced probably super normal kind of growth, more growth in the business than they would have experienced otherwise, and they've essentially then gone on to have too higher expectations of sales after those initial lockdown periods. Now, the second part of this update is around the Daigou channel and the ongoing struggles that A2 Milk continue to have with that channel. So initially, the A2 Milk Company came out a few months ago, and they've sort of mentioned this on an ongoing basis, that they are struggling with some of their reseller channels. So particularly in Australia, they blamed a lot of the lockdowns on some issues around people basically being able to go into stores, buy the A2 Milk products, and then resell it to people overseas and so on, which is kind of what that Daigou channel is. And that sector has really, again, continued to struggle. And I think that's for a couple of reasons. Firstly, the lockdown, of course, certainly had an impact on that channel. The other part of it, I think, again, is kind of stocking up as people were going into lockdowns. I've heard reports of, people over in Australia, being limited to a certain number of cans of infant formula per person when we were first going into lockdowns. And I think the inventory that people sort of have personally in these reseller channels has gotten really high, and is frankly going to take some time to just clear out. And it was also clear from some of the questions and answers that happened in the conference call following this press release that A2 Milk really do want to continue to focus on this Daigou channel and try to get it back up to where it was. But it is down significantly, and they expect that to take some time. And in the meantime, they're going to be a little bit more reliant on the Chinese market than they even were in the past. And they were, already very reliant on that Chinese market. But the Daigou or reseller channel is really unlikely to be what it used to be, especially in the next 6 to potentially 12 months. Now, one final thing I'll just briefly touch on before I get into kind of my thoughts in terms of whether I'm considering potentially buying or selling shares in the business, and some of my thoughts on analyzing the company in general and intrinsic value and so on. Before we get to that, the last part I want to touch on from the press release is around share buybacks. So the last point in the press release was, in addition, the board is actively considering capital management initiatives, including a potential share buyback, and an update will be provided at the full year results in August. So buying back shares is really not a common practice for many New Zealand companies. So in New Zealand, we have a system where you can make dividend payments and have imputation credits, which basically is a way of avoiding double taxation on dividends like you might get in US companies, for example, where the US business pays tax on their profits, and then if they pay out a dividend to individuals, those individuals again pay tax on that dividend. So there's kind of a double taxation going on. We really don't have that to a significant extent in New Zealand because we have these dividend imputation credits. And that really means that share buybacks are actually a lot less attractive than they might be for many companies in the US, which is sort of a way of returning capital to shareholders without having these significant tax consequences. But at the same time, share buybacks, if done correctly, can be extremely powerful for creating value for shareholders. If you're able to buy back shares at below their intrinsic value, below what they're fundamentally worth, then that creates value for remaining shareholders. But vice versa, if you overpay for those shares, just like if you overpay for an investment, if you're buying the shares straight up yourself, overpaying for those shares can be value destructive in nature for ongoing shareholders. So although share buybacks can be very, very powerful, they certainly have to be done at the right prices. So let's talk about intrinsic value and kind of valuation in general for the A2M.AX business and how I'm thinking about that today. Now, in previous video updates that I've done for the A2M.AX business, I've actually gone through and done intrinsic value calculations. I don't intend to do an update on that for this particular video, frankly, because the equation for me is getting very, very simple. And really, it comes down to the business outcomes more than the minutiae of changing growth rate percentages in intrinsic value calculations at this point. Now, if you want to go and check out an intrinsic value calculation, recently updated for the A2M.AX business, fellow YouTuber Investing with Frank actually just put out a video on that. So I largely agree with many of the numbers that he's come up with for that business. So head over and check that out if you're interested in seeing some specific numbers. But basically for me it goes like this. Now, if you have a view that the A2M.AX company is basically never going to recover from this and they're going to have this sort of lower baseline of revenue and free cash flow and earnings and so on, and they're going to grow a little bit more slowly than they might have done in the past, I think that the current price for A2M.AX after this drop is probably reasonable. Now, if you look at one of the lines from this press release, from the full press release, management basically came out and said that if you backed out some of these one-off costs and inventory adjustments and so on that are going to happen very soon, basically annual revenues for the business would be about 1.3 billion with an EBITDA margin in the low to mid-20s. Now, if you basically run through those numbers and apply that low to mid-20s EBITDA margin, and then assume that they're converting, say, roughly 70% of that EBITDA to free cash flow, which is about what they did in 2020. I come up with the A2M.AX business trading at a free cash flow multiple today of roughly 20 to 25 times earnings, depending on exactly what free cash flow number you use. Now, if the A2M.AX company, again, kind of stays at this baseline and grows, much more slowly than they've done in the past, I think that's probably fair to maybe even slightly expensive, potentially. The A2M.AX company, even if it doesn't grow as fast as it has done in the past, is a really good business. It doesn't require a lot of capital. It produces a very high return on equity. They have no debt, and they have a brand and a product that people really, really like. And that deserves a much higher valuation, in my opinion, than some commodity product, which a lot of people kind of like to put them into that camp, and I really don't think they deserve to be there. Certainly there's an argument that they could be there one day if they just get demolished by competition and other A2M.AX, brands and so on, but I really don't see that happening, and A2M.AX at the end of the day is a very good company that generates a lot of cash flow. Now, on the other side of the equation, if you're someone that genuinely believes that this is a event that is short-term in nature for the A2M.AX business and By short term, I mean anywhere from 1 to 3 years. That's not typically short term for a lot of people, but that's how I define it. If you think that this is a short-term event for the A2 Milk Company, and you think in 1 or 2 years' time they will have cleared the inventory issues, we'll be through the pandemic, the Daigou reseller channel will be back to roughly normal, and the A2 Milk business will be growing basically as it has done in the past, then you can very easily get to a point in a discounted cash flow analysis, for example, where A2 Milk looks ridiculously cheap today. Now, potentially upwards of a 50% margin of safety. And of course, entertainment purposes only, this is not a recommendation to buy or anything like that. But that for me currently is kind of how I'm thinking about it. I'm not necessarily saying that I fall on one side of the argument or the other, but I think that's basically how the numbers stack up. If A2 Milk doesn't perform as well as it has done in the past, I think it's roughly fair priced today, potentially slightly expensive, but roughly fair price. And I think if the A2 Milk business does return to growth and get back to where it was in the past, it's potentially much, much more valuable than where it trades at today. So those are some thoughts on the A2 Milk business. Again, always interesting to follow these updates, and I do hope you enjoyed it. If you did, please hit like and hit subscribe. It does really help me out and support the channel a lot. I'd love to hear your thoughts on the A2 Milk Company down in the comments below. I know it's becoming a bit of a controversial one here in New Zealand, so I'd love to hear your thoughts on that. But that is it from me today, and I will see you in the next one. Cheers.